What is a P/E ratio and why every investor needs to know it? Most people checking their Robinhood app have absolutely no idea what separates a $50 stock that's actually a bargain from one that's about to collapse. And that missing knowledge could cost you tens of thousands of dollars. Today we're breaking down the single most important number every investor needs to understand. The price-to-earnings ratio, or P/E. This one metric could change how you invest forever. Let's jump in. Here's what you need to know first. The P/E ratio is simple. It's just a company's stock price divided by its annual earnings per share. That's it. But here's why it matters more than almost anything else. It tells you exactly how much you're actually paying for every dollar of profit a company makes. Think about it this way. Imagine you're buying a coffee shop. You wouldn't just look at the asking price, right? You'd want to know how much profit that shop makes every year. A shop asking $500,000 that makes $100,000 annually is way different from a shop asking $500,000 that makes $10,000 annually. That's the P/E ratio in action. Same asking price, totally different value. Let me give you a real example. Let's say Apple's stock is trading at $180 per share and they earned $6 per share last year. The math is simple. $180 divided by $6 equals a 30 P/E ratio. What does that mean? You're paying $30 for every dollar of profit Apple generates annually. Now compare that to a utility company stock trading at $50 with $5 in earnings per share. That's a 10 P/E ratio. You're only paying $10 for every dollar of profit. On the surface, one seems way cheaper. But here's where most investors mess up. Why the P/E ratio actually matters. A higher P/E isn't bad. It's not good either. It just tells you what the market expects from that company's future. Apple's 30 P/E reflects investor belief that Apple will keep growing. The utility company's 10 P/E reflects belief that it'll stay stable and mature. Here's the critical insight. When you look at stocks on Fidelity or any brokerage, you're seeing two P/E ratios. The trailing P/E uses the last 12 months of earnings. The forward P/E uses predicted future earnings. The forward P/E is what really matters because you're buying the future, not the past. Let me hit you with real numbers. The S&P 500 average P/E ratio sits around 18 to 22 historically. When you're looking at stocks in your portfolio or considering adding something to your Roth IRA, that's your baseline. A stock with a 15 P/E in an S&P 500 context might be undervalued. A stock with a 35 P/E might be overheated unless there's a real growth story behind it. Think about 2020. Tesla had a P/E ratio over 100. Was it overpriced? Maybe. Was it overpriced according to what the market believed about electric vehicle dominance? No. Tesla delivered on that thesis. And investors who understood the P/E ratio could see the bet they were really making. How to actually use this? Here's your action plan. When you're evaluating any stock, follow 3 steps. First, find the P/E ratio. Every major platform has it. Robinhood, Fidelity, Yahoo Finance. It takes 5 seconds. Second, compare it to the sector average and the S&P 500 average. A tech stock with a 25 P/E might be cheap compared to its peers averaging 35. A bank stock with a 12 P/E might be a screaming bargain in a rising rate environment. Third, and this is crucial, understand why the P/E is what it is. Is it high because growth is expected? Is it low because the company's struggling? A P/E by itself tells you nothing without context. Here's what most beginners get wrong. They think a high P/E means don't buy and a low P/E means buy. Wrong. A high P/E from a stable, growing company could be the best investment you ever make. A low PE from a company heading toward bankruptcy is a value trap that destroys portfolios. The PE ratio is a conversation starter, not a conclusion. It's the first question to ask, not the last answer you need. If you're building wealth in your 20s and 30s through your 401k or Roth IRA, this becomes your superpower. You can look at any investment option and instantly understand if you're getting a fair deal. That knowledge compounds over decades. Now you've got the tool. Start using it. Look at 5 stocks you own this week. Check their PE ratios. Compare them to their peers. You'll immediately see your portfolio in a completely different light. If this helped you understand the market better, hit that subscribe button. We're breaking down more investing concepts that actually matter every single week. You've got this.